Hello traders, the title of the video is Practical Fibonacci Trading Tips. Let's get started. We are on a monthly chart of Ocular Therapeutics Incorporation, EPIC OCUL, Oscar, Charlie, Uniform, Lima. This is an American stock that belongs to the healthcare sector. And we want to talk about practical Fibonacci trading tips. Alright. So as you can see, I'm on the monthly chart and the financial instrument Ocular Therapeutics Incorporation was going down. Alright. So then we apply Fibonacci retracement. Alright. So I put it at the closing price instead of the top here. This is one way that a lot of Fibonacci traders are drawing their Fibonacci retracement level. And after that, they want to highlight the 38.2% Fibonacci retracement level, the 50% Fibonacci retracement level, the 61.8% Fibonacci retracement level, and the 78% Fibonacci retracement level. And what usually takes place after the price goes down, alright? A lot of Fibonacci traders, the first group of Fibonacci traders will attempt to sell as the price reaches the level of the 38.2% Fibonacci retracement level. Why? The reason why they attempt to sell it there is because, alright, the dominant force is bearish. So the bearish traders are the dominant force, okay? Therefore, they want to sell. So the market is saturated by the bear. So as the price is approaching a key resistance level, they will try to sell it. But there is one mistake that traders are making, is that one should not just sell because the financial instrument reaches a Fibonacci retracement level. Now, to improve that strategy, one can also check is that a specific Fibonacci retracement level is also corresponding to a previous resistance level. Did other traders sold the financial instrument when it was at that point in time? Okay, at that point. Okay, there is the next level that the trader will attempt to sell. Some of them are gamblers. They just want to sell because of the Fibonacci retracement level, which is completely wrong. The next level that they are watching is the 50% Fibonacci retracement level. Now, there is a good reason, and in fact, investors, hedge funds love to sell around the 50% Fibonacci retracement level because it is a psychological price level. Price going down, all right, dominant for bearish. But if it goes above that 50% Fibonacci retracement level and find a support, it means that it's now becoming bullish. So instead of looking for an opportunity to sell at 38.2%, it's better to sell, to look for, not to sell, to look for an opportunity to sell at the 50% Fibonacci retracement level. But the question again, is that 50% Fibonacci retracement level corresponding to a specific key resistance level? Sometimes the 50% Fibonacci retracement may be here, but a better resistance level may be above. Therefore, the smart money will not sell at the 50% level, but will sell at a better resistance level because they are trading the price. When I'm talking about better resistance level, it means that the best place where, okay, financial market traders showed it before. So you can see this candlestick bar here, it got a long tail. So not a long tail, a long shadow here. You can see that people were selling in this zone, and the best place they were selling was where I placed the cursor here. Though the 50% Fibonacci retracement is below here, smart money will prefer to sell somewhere above that level. There is another level that Fibonacci trader would like to sell, talking about practical Fibonacci trading, is the zone between the 50% and 61.8% Fibonacci retracement level. Is also called the sweet spot zone. I don't know whether we should use the word sweet for selling or whether it's only true for buying, because the normal direction of the price is bullish. So that's why they use the word sweet spot. Price was trending first and then pulled back to the zone of 50% and 61.8% Fibonacci retracement level. They call it sweet spot zone, where they want to buy again one more time. But in a downtrend, should we call it sweet or beta spot trading zone? Let me know in the comment section. All right. So, so the zone between the 50% and 61.8% Fibonacci retracement level is quite a reliable zone to look for for best Fibonacci trading setup. All right. So price goes down, dominant for bearish. Price return to the 50%, 61.8% Fibonacci retracement level. Definitely there will be some sellers here. One more time, check whether people did sell the stock there before you also attempt to sell. Remember that we are using a Fibonacci retracement or Fibonacci extension only to look for trading setup. Once we identify a trading setup, one must now use multiple time frame trading method without ignoring the trading triangle and other market participants. So apart from the sweet spot zone, there is another level where traders will try to sell. So what usually take place? So price goes above the sweet spot zone, or at the 50% and 61.8% Fibonacci retracement level. Okay, all right. And then people say, bullish traders say it's going to be bullish, all right? Then there is a trap. Where is the trap? The trap is the 78% Fibonacci retracement level. That's the trap there. Why is it a trap? Most of the time, it's a trap for stock that do not have strong fundamental. So if somebody asks you what is the Fibonacci trap for stock that do not have strong fundamental, just because sometimes stock may be fundamentally bearish or weak, but may benefit from the market sentiment. So if the market sentiment is bullish, if the sector is bullish, though the fundamental, the valuation of the financial instrument does not allow smart investor to buy, the stock will continue to go up. And the fundamental trader will be saying, what's going on? Why people are buying this stock? They should sell it. The stock is overbought. They shouldn't buy it, all right? But because the market sentiment is bullish, people will continue to buy the stock. It doesn't matter. So for those traders, there is a trap at 78.6% Fibonacci retracement level, because as the price reaches that level, smart money will hard enough, will say, well, it's time to sell it now. It's well overbought. Fundamental are weak. They are not making money. Management are not handling the company very well, and they will just come here and sell. Sometimes the selling activity at 78.6% level, Fibonacci retracement level, can be quite intense because, fundamentally speaking, the company one should not buy, is overbought, and they are not making money. People want to sell, and they will just selling it at 78.6% Fibonacci retracement level, and people will be wondering what's going on, and the stock will come down 1, 2, 3. So be aware of the trap at 78.6% Fibonacci retracement level. I need to remind new traders that I do not use 78.6%, I use exactly 78%. Alright? So the first thing, so you need to understand, talking practical Fibonacci trading, what do we use the Fibonacci retracement for? All right? We use the Fibonacci retracement to identify trading setup, where at the Fibonacci retracement levels, 38.2%, 50%, 61.8%, and 78% Fibonacci retracement level. We ask the question, okay, what is the dominant force? All right? And then we check the fundamental. One should not use the Fibonacci retracement, which is a technical trading tool, on its own. One should always combine it with the fundamental trading. All right. So this is the first part of the discussion about practical Fibonacci trading. What I will do, I will title this one. I will correct a little bit my title. I will call it, in fact, practical Fibonacci retracement. Okay, trading tips. Okay. At Fibonacci, because we were talking only about Fibonacci retracement, I'll call it practical Fibonacci retracements trading tips. Alright, so those are the key levels that professionals are watching. High probability trading setup will occur between the 61.8% and the 50% Fibonacci retracement level. And if the fundamentals are weak and the stock pushes to 78% level, be ready to see intense selling. The opposite is also true for bullish stock that retrace to the zone of 50%, 61.8%, or the 78% level. A stock that is intrinsically bullish, fundamental are solid, all right, but that is a caught, so to speak, caught in a bearish, market, all right, may be going down all the way to the 78% level. At that point in time, smart money that know that, okay, all right, this stock is very, very oversold. They are still making money, but the market sentiment is bearish. That's why they are going down. They will start buying from the 78% level. All right? So the zone of 78% is a highly discounted zone for stock that are truly bullish, intrinsically bullish, and they will start buying there. And they don't care whether the stock will continue to go down even to the 100% level. They will keep buying it, accumulating the stock over a long period of time, waiting for a new trend to begin, because they are prepared. Those are long-term investors that are prepared to hold their position even for 5 years. So understand, okay, what is going on with the Fibonacci retracement. Ordinary trader, technical trader, investors, hedge fund, okay, what is going on? Always combine the technical analysis and the fundamental. When a Fibonacci retracement corresponds to a key level, it's very, very interesting, but always look for a valid trading setup. Do not assume anything, and in all cases, use a top-down trading method. Remember the sweet spot zone, the 78% Fibonacci retracement level. All right? Okay. Another thing I need to add before we close this video is that when a financial instrument was bearish before and it reached the 50% level, which is the psychological level, most market participants will expect a continuation if the fundamental did not improve. The opposite is also true in an uptrend. The 50% level, stock pull back to the 50% level if the fundamentals are solid in a bullish market, all right, and they are making money, the cash flow is coming in, management is good in place, they will start buying it from that zone. They will expect a reversal or a continuation of the prior trend. So prior trend, if it was bullish and I pull back to the 50% zone or the sweet spot zone, fundamental are solid in a bullish market, that stock has a high chance. If the market sentiment is bullish, it's high chance to return back up a bit. All right, there is I will be talking about Fibonacci extension, talking about practical Fibonacci extension trading tips. We will be talking about it in another tutorial. If you have any question or suggestion, this is your time. Put in the comment section, and in due course I will be busy recording another video to answer your specific question. We are the TSTW24 traders talking about practical Fibonacci retracement trading tips. Happy trading to you all, and speak to you soon.